Have you ever wanted to find a place where you can find answers to all your options trading questions? Have you ever wanted to find a place where you can go to learn about options without having any previous knowledge about them? If so, you've come to the right place. At Options in Plain English, you're going to learn about options, and you're going to do so in a way that's going to make your life easier, because you're going to be understanding in simple and clear terms all you need to know about options. Today, we're going to talk about call options. And in order for us to learn about what a call option is and how you can use them, we're going to be using examples that are going to make it easy for you to understand the main function and the main usefulness of options and how you can use them to achieve your objectives. We'll start with our trader. Our trader is a motorcycle expert. He knows a lot about motorcycles, and he knows that there's a model that's coming out very soon. And this model, he thinks, is going to have a lot of interest among motorcycle enthusiasts, and this is going to be reflected in a lot of demand for them. And he thinks that there's going to be some way to profit from this interest and from the price increase that this is going to bring to the motorcycle market. So now he knows that this model is going to be coming out soon, and he knows that that he can put in a pre-sale order to buy it for $10,000. This is going to be the initial price. This is what is going to be priced at first. And he thinks that the price is going to go up because of all the interest that this is going to generate. But he doesn't want to have to buy one, hold on to it, and later on sell it in order to profit from it. He wants to exploit his knowledge of the situation, his knowledge of the market, by going to his motorcycle dealer and offering them a deal. Instead of putting in an order for as part of their pre-sale orders, he thinks he has a better solution. He's going to offer them a contract that is going to give him, our trader, an option that is going to be the right to buy this motorcycle for $10,000, which is the price that is going to come out at, for 7 days, for a period of 7 days, after which he's no longer going to be able to buy it at that price. So if it's higher, he's going to have to, if he wants to, he's going to have to buy it for a higher price. So during these 7 days, he's going to be allowed to do this. And in order to receive this right, he's going to pay a premium of $800. So there's going to be $800 going from our trader to the motorcycle dealer, which is going to be basically the motorcycle seller. And with this, he's going to be in a position where he's at any point during these 7 days, he's going to be able to buy the motorcycle for $10,000. So what he's hoping for, obviously, is that the price in the market is higher, so that he can take this motorcycle that he purchased for $10,000 and then sell it immediately in order to realize a profit. So he does that. The motorcycle dealer accepts this because they're gonna be getting the premium that he paid for the option contract is going to be with the motorcycle dealer regardless of what happens. This is money that goes into their coffers. So it's something that they're very interested in, and they grant him this contract. They agree to it, and those are the terms: is the right to buy one motorcycle for $10,000 during 7 days, the next 7 days, and for a premium of $800. Of course, you might be wondering why. What is in it for the seller, for the dealer? In this case, well, maybe the seller is going to make a profit if they sell for $10,000 regardless. So even if there is a price increase and the market now, these motorcycles can be sold for $14,000, they're still making a profit at $10,000. So they're in a way getting this money. They're protecting themselves with these $800 they're going to keep no matter what. So they agreed to the contract, and now the 7 days are going to start, and we'll see what happens. We have them there. On the first day, well, it seems that our trader misjudged the situation, and the market is not supporting a price of $10,000. In fact, because of lack of interest, there's a rumor that perhaps there's a problem in the mechanics of the motorcycle or something like that. Maybe something that's unfounded. We don't know. But the price that the market's willing to pay now is $4,000. So he has the right to buy a motorcycle for $10,000, but the market is at $4,000. So would he use this contract there? Of course not. Why would he use a contract that gives him the right to buy at $10,000 if he can buy it in the market for $4,000, which he's not interested in doing anyway? So at this point, this is very important. At this point, he would, if this stays like this for the 7 days and it never approaches the $10,000 mark, then he's going to lose his entire $800 that he paid. Now, keep in mind, the motorcycle in pre-orders was selling for $10,000. So whoever bought this motorcycle or put an order in is going to get it for $10,000, and they're going to be out $6,000. So he, in a worst case scenario situation, which we still have 6 days to go, so we don't know what's going to happen. But in the worst case scenario situation, he's going to be losing only $800. In the second day, things get a little bit better. People start getting interested in it, and it goes up to $8,000. At this point, he's not interested, obviously, because the price that he agreed to pay is $10,000. So it doesn't make sense to use it if you can get in the market for $8,000. So he doesn't use his contract. Third day happens. Now it's at $10,000. So at this point, you might be wondering, well, he could use his contract or not. It'll be the same thing. So if it's the same thing, he's not going to use it because he can hold on to the contract. He's only risking, so to speak, $800 that he paid as a premium, which that money's gone. But now he can wait a little bit longer. So on day 3, he's not going to be using his contract, and he's still down $800. At least he will be down if this price holds until the end of the 7-day period. On day 4, we cross the $10,000 barrier, and we're at $10,500. He's still not going to exercise his contract. He's still not going to use his contract. Why? Because even if he uses it, because he paid $800 for it, if he makes this contract valid, he buys it for $10,000, turns around and sells it for $10,500, then he's only going to be making $500 as a profit. It's not even going to cover his the premium that he already paid. So he's not going to exercise his contract, and he's going to be down $300. Now, notice that now he's in a better position because it's over the $10,000 price, which was the initial price that he has the contract for. Day number 5, now we're talking about $12,000 that's in the market. You can buy or sell a motorcycle for $12,000. So he decides that he's going to use his contract and he's going to send the $10,000. He's going to probably use his savings, or you can, if a bank knows that you're gonna be borrowing money from them, and that you know that they know that that this money is going to be used to buy something that you're going to be turning around and selling, they're probably going to be able to loan you the money, no problem. So he sends the $10,000 to the seller, to the motorcycle dealer, and the motorcycle dealer sends the motorcycle to him. He turns around and sells it for $12,000. So if we summarize what happened here, we can see that he paid $800 for the contract, and then $10,000 for the actual motorcycle, and then turned around and sold it for $12,000. So altogether, he made a profit of $1,200. So $1,200. He was only risking $800. He had a profit of $1,200. So it's not a bad deal. But what would have happened if he would have waited a little bit longer? Let's say on day 6, everybody's looking for a motorcycle. There's a shortage of them, and the price rises immensely. It's trading now at, or is in the market, changing hands for $21,000 on day 6. So if he would have waited, now at this point, he would have had to have paid $810,000, which he's gonna have to pay anyway, and then he could have sold it for $21,000 to make a profit of $10,200. On day 7, finally, which is the last day of the contract, he would have, now the price is $30,000, so it's a big windfall. It's a big profit. He would have made $19,200 because of the $800 plus $10,000 that he had to pay, and then $30,000 coming in because of him selling his motorcycle in the market. So $19,200, and he was planning on risking only $800. It's an interesting deal. It was a good proposition at making $1,200. So you can imagine if you can make $19,200 with an initial investment of $800. Now, it's important to point out here that the way this contract is structured, it has an expiration date, and after day 7, if he hadn't used it, it would have expired and no other transaction would have taken place. The seller, so the motorcycle dealer, the one who agreed to the contract, would have kept the premium that he already paid, similar to how an insurance works, how an insurance policy works. That premium's already been paid. If he doesn't use the contract, then nothing's going to happen. Just the premium's going to stay with a dealer in this case, and it would have been a pretty good deal for them because they wouldn't have had to sell anything at $10,000 or otherwise. Now, if we keep analyzing this situation, what would have happened if instead of writing this contract and having the $800 of premium paid to the dealer and to get this right to buy the motorcycle, instead of this, if he would have bought the motorcycle, if he was really sure that there was going to be a lot of demand, so he's going to put in a pre-order and he's gonna pay the price. He's gonna pay the $10,000, and then what would have happened on these different days? So on day 1, The motorcycle was changing hands. The motorcycle was going for $4,000. So at that point, he was losing $6,000. On day two, it was going at $8,000. So he would have been down $2,000. Day three, it was going for $10,000. So he was pretty much even on that transaction. On day four, when it was going for $10,500, well, he would have made $500. On day five, he would have been making $2,000 because $12,000 he would have been able to sell the motorcycle for $12,000. On day six, for $21,000 he would have been making $11,000, and finally on day seven he would have been making $20,000. So what's interesting about this is that we can see how these two situations are different. So for example, here on day one, he was down $800 pretty much versus $6,000. So his loss was kept constant. He wasn't able, he under no circumstance was he going to be losing more than $800. Same on day two. Now on day three, you can see that while he was losing his whole premium because it was the price of the motorcycle in the open market was the same as the price that they agreed to have the contract at. He was losing the premium, but in the market, he wouldn't have made any money. He was pretty much even on that transaction. On day four, when it's trading at 10,500, when that's what the market is getting, we can see that at that point, if he had bought the motorcycle, he would have been making 500 because of the difference between 10,000 and 10,500. And if he uses the contract, he would have been down $300. Now, on day 5, 6, and 7, we can see that there is a little bit more profit, actually exactly 800 more of profit when he used his, if he had bought the motorcycle outright. And the difference is because of the $800 that he paid in premium. So it's a cost of writing this contract, of agreeing to this contract. So we can analyze this also by comparing the percentages of return on their investment. Now, keep in mind, in the top half of this analysis, we're talking about an investment of $800. On the bottom half, which is when if he had bought the motorcycle outright, we're talking about an investment of $10,000. Okay, so on day one, it would have been, if it had stayed at that price for the whole period, he was pretty much out his whole investment, 100%. And he was losing 60% of his investment if he had bought the motorcycle. Day number two, he was losing his whole investment on the option side, on the contract side, versus a loss of only 20% on the outright purchase of the motorcycle. On day three, he was even if he had purchased it, and with his contract, he was still going to lose his whole investment, assuming the price kept stable for the remaining 4 days of the contract. Day four, we can see things start to change. Now he's only losing 37.5% versus a 5% profit on the outright purchase of the motorcycle. Now day five, when we start getting into the explosion in the price, now we're talking about 150% return versus a 20% return. Now remember, we're talking about $1,200 on an investment of $800 versus a $2,000 profit for an investment of $10,000, so it's 20%. And if we keep going, now we're talking at $21,000 on the outright purchase. We're talking about a profit of 11,000, which is a respectable 110%, but making $10,200 on an investment of 800 is a 1,275% return. Impressive. And on day 7, of course, we're talking about a 2,400%, 2,400% of return on his $800 investment versus a return of 200%, which is amazing as well. But you can see how in the case of the contract, we have a lot of leverage. We're controlling much more. We are amplifying profits, and also we are keeping losses constant, even though there's a pretty big range, or there is a significant range where we would lose our whole investment. Basically, anything below the initial price of $10,000 would be a loss for the contract, whereas the return on the outright purchase of the motorcycle is precisely that. Whatever the change in price is for the actual motorcycle in the open market. So far, we've only talked about the possibility of making profits in this transaction by using the contract that was agreed to, and pretty much using the contract, buying the motorcycle at $10,000, then selling it for a profit. What would happen if there was a market for the option itself? What if there was a market for the contract itself? And let's call it an options market, because the contract is pretty much an option. It's a contract that unilaterally gives only the buyer the right to purchase a certain good, in this case a motorcycle, for a certain price during a certain time. The seller, in this case the motorcycle dealer, has no input into whether this contract is used or not. It's only the buyer, and the buyer is not obligated to do it. So if the price is always 5,600, 5,000, 6,000, 9,000, and it never goes above 10,000, he doesn't need to use it. He doesn't need to buy the motorcycle. He can elect to let it expire and take his $800 loss only. That's why it's an option for the buyer or for the holder. In this case, in this market that we are creating here now, we're not going to talk about using the option. You're not going to be talking about exercising the option. We're going to be talking about the price of the option itself. So on day 1, when it was $4,000, when the motorcycle in the open market was going for $4,000, the option in this case would not be zero, would not have a lot of value, but it would have some remaining value, $50, for example. Why? Because, well, think about this. You could buy something for $50, which is the right to buy it at $10,000. And what if the price shoots up, which actually ended up happening? You could make a lot of money putting down only $50. So because this option contract is only, it can only be advantageous to the buyer, even if the probability is really low, it's still going to have a certain value. So if the price of the motorcycle is $4,000, the price of the actual contract might be $50. So in this case, the trader can take the contract and sell it in the market. So the $800 that it cost him to enter into this contract, he's going to recover $50. So he's losing right now about $750, which might not seem like a big difference, but think about it. Look at the $800. So pretty much, instead of losing everything, he's got the option, he's got the possibility of bailing out on this bet that the motorcycle was going to be surging in price, and leave with at least a little bit of residual value. So this market is pretty good. And also, we'll see later that it eliminates the need to actually exercise a contract. So on day 2 at $8,000, maybe that option now has a price of $200 in the options market, not in the, we're talking about the options market, not the open market for the motorcycle. So keep in mind, number one thing to notice here is whoever bought the option on day 1 at $50 already quadrupled his or her money. So if the price is now $8,000, our trader is only losing $600. And whoever bought the option at $50 already quadrupled his money. So not a bad deal. On day 3 at $10,000, maybe the option is not going to be worth what he paid for it, because he paid $800. Now it's trading at $600 because his option was for 7 days. Whoever buys this option now is going to be only for 5 days, including today. So we can see that the value of the option contract depends on how long it is. If he was given 14 days instead of 7, the value, the price, the premium that he paid would have been higher. Not exactly twice as much, but it would have been higher. So at this point, instead of pretty much losing his whole investment, if you look at the options market on day 3, he's going to be down $200. So $800 versus $200, not a bad deal. On day 4, at $10,500, maybe the option market is going to be pricing his option at $800. So at this point, $10,500, instead of being down $300, is going to be about even. So not bad. On day 5, though, when it's trading at $12,000, the motorcycle, you can buy one or sell one for $12,000. Maybe the option is going to have a value of $2,200, $2,200. Why? Because it has to have a value of at least the $2,000 that it's over the price that he's going to be able to buy it at. So at least it has to be $2,000. But because there's 3 days remaining, there's an additional component to this option price, to this contract price, to account for the probability or the possibility that it might keep going higher. So at this point, instead of being up $1,200, he's up $1,400 because of this remaining value, this additional value over the actual intrinsic, so to speak, value of the contract. On day 6, when it's trading at 21,000, let's say the option is going to be worth 11,100, so he's going to be making 10,300 instead of 10,200. On day number 7 at 30,000, there's no more time remaining. This is the last day, so he's going to be trading exactly for the difference between the market price, which is 30,000, and the price that this contract that this contract allows you to purchase at. So instead of it trading at 30,000, you could use the contract, buy at 10,000, turn around, sell it at 20,000. So sell it at 30,000, so making 20,000 in profit. So this is what it's going to be trading at. because there's no more time remaining. So it's only the real tangible value that this contract has, the price that is going to be trading at, because it's the last day. So now he could just go to the options market, sell it out, and have the same profit as the one who was actually using the contract and doing the whole process of taking the contract, notifying the seller, taking possession of the motorcycle, sending the money, and then turning around and selling it. Instead of doing all of that, he can just take the actual contract and sell it in the option market. So in other words, the trader could bet on the price of the motorcycle and make money on it without ever having to take possession of a motorcycle, without him ever going to the seller and actually asking him or her, requesting the purchase at the agreed upon price. Nothing like that. Just take the contract, the one that you agreed to, and sell it in the market. You get it, you buy it in the market, and you close it, and you take your profit and go. This is the beauty of having an options market. The fact that you can bypass the whole other process is very good, because you need to deal with that, and he doesn't need to come up with $10,000 to actually purchase it before he sells it out. He sells the motorcycle out, just takes the option, it increased in value, sell it out, get the profit. That's it. That's the beauty of the options market. That it's a market where your contract that expires a number of days from now is being traded and is being priced in real time, and you can you can realize your profits, monetize your contract, do whatever you want anytime. So that's the beauty of an options market, and that's the reason why, for people who engage in these kinds of deals, which later on we're going to see that those are financial options, for the most part, they don't exercise and they don't take possession of whatever it is that the underlying was, that the underlying asset was. They just go to the market and sell it out, and that's it. This is why this is so important, and this is why this is so huge. First of all, you can see that with options, which this contract is, you have a limited downside, and you can have a very, very highly leveraged results on the upside. So this is why this is such an important tool and such an important instrument to understand. And it doesn't matter what it is, what you see from now on, you will now know that this is what call options are for. Now that we know the importance of the options market and how beneficial this deal was for the trader, and we could say also for the dealer, because they got $800 for this contract, and they were probably already making money at $10,000. So maybe the actual cost is $8,000. So they were not risking a lot. They were risking the upside of $10,000. Anything above $10,000 they were risking, but they were getting $800 for sure. So it's a convenient way of laying out the risk, of laying off the risk. So the risk of the trader was not the full cost of the motorcycle, along with maintenance costs and all of that, but only the price of the contract. So now that we know all about this particular example that we saw, how does that translate to the actual financial market, to the actual options market that you're going to be dealing with? Well, our trader was the option buyer, the one who was acquiring the option holder, the one who has the right but not the obligation to carry out whatever is in the contract terms. The motorcycle dealer was the option writer or the option seller. Those are the two terms that this actor is known as in this case. The contract is called a call option. There's two types of options. Maybe you know by now. I'm pretty sure you know by now. This is the call option. It's an option to buy. The other option, we're going to be talking about it later. It's a put option, which is an option to sell. Not the obligation, but the right to buy is a call option. And not the obligation, but the right to sell is a put option. In this case, a call option, the right to buy. The motorcycle was the underlying in this case because it was the good that was to be purchased, acquired, bought, etc. The underlying price was the market price for the good or the asset. And this is sometimes called also a spot price because it's the price right on the spot, right now. Now, what about the $10,000, the number that was in the contract? Well, that's called a strike price. So the option was for one motorcycle, that was the underlying. $10,000 was the strike price. So if it had never been over $10,000, then the trader would have lost his whole investment because the price would have never gone above the strike price. 7 days was the expiration. So every contract has a duration. It's not forever. This is a fundamental difference between an instrument such as a stock or an ETF, an exchange traded fund, or bonds or any other kind of instrument, or actually similar to a future contract. These ones expire. They cease to exist. So it's important to keep this in mind because it means that when you buy it, you're going to have to do something with it with at least the number of days that are specified by the expiration, by the duration. And the premium, which is the option price, this contract right here has a price. The price is called an option premium or option price. And it's very similar to an insurance premium. So when you buy an insurance policy, you pay a premium. This is something like that. You pay a price for the possibility that something might happen. In this case, the price goes up a lot, and you make money because of that. This is what you're paying for. This is the option price. Don't mistake the option price with the underlying price. See how different they are. And one of them is $800, for example, to begin with, and the underlying price was $10,000. The process whereby when the trader had the contract and decided to make good on it, to actually use it, that contract is that process is called an exercise for the trader and an assignment for the seller or the writer. So he's exercising his rights to buy. And he is not doing anything, but is being assigned. He is not an active participant. He's a passive participant. This is something very important to understand. The buyer controls the contract. He's only going to use it if it's advantageous to him. The seller is assigned, can only wait to either be assigned or not. If the seller writes a contract, enters into this agreement, and the price never goes over 10,000, then he or she or they get to keep all the premium. So this is what an option writer would get. And now, when a trader went to the market initially, when the trader entered into this agreement, that transaction is called a buy to open transaction, because he's buying to initiate this potential transaction, or this transaction that could later on become an exercise. But if the trader decides not to exercise, but to actually monetize the contract, to get the money, to make the profits for that contract in the options market just by selling the contract, that is called a sell to close transaction, and that ends the whole transaction. That's when the profits are made or the losses are made. So this, of course, was an example on a day-to-day situation. But in the financial markets, when we're talking about an option, we'd be talking about, for example, stocks. Any kind of stock. It could be Apple, Google, Microsoft, Amazon, Boeing, Sears, Macy's, US Steel, all kinds of companies. Any company that has stock trading in the open markets, in the public markets, most of them, I would say pretty much all of the liquid underlying, sort of the liquid stocks have options on them. So that would be the underlying. They trade at a certain price, and then there's an options market where you can go and get in this case, we're talking about calls. So now we're going to talk about financial instruments. So in this case, we're going to talk about a stock, Netflix, but it can be any stock or any financial instrument that has options for them. So Netflix has its price chart right here. So this is the price of Netflix. Right now it's trading at around $370. And what we're showing here is a trading page. On the top part, you can see the price chart, and on the bottom is an actual trading page from a trading platform. In this case, we are using here Thinkorswim, but it can be any broker. Actually, most brokers are going to show you just about the same information, maybe laid out a little bit different, but it's pretty much the same information. It has to be, because this is how options work. So the first thing that you can notice here is that the trading page, we're going to be analyzing it, but right now, right away, you can see that it has a right portion and a left portion. In this case, the whole left section is for calls, which are the options that we actually analyze today. These are calls, all of these. And on the top of the trading portion, the trading page, you can see the underlying, in this case, NFLX, so the ticker symbol for Netflix. You can see the underlying price, which is given in a bid and an ask. You can see the expiration, which is in this case 42 days away, but you have all the expirations here. The strike price, very important. You can see that we have several strike prices, but in fact, we're not showing all of them. I'm only showing 10. There's plenty more for this expiration. There's plenty more for every expiration. So there's a lot of options you can pick and choose, which is one of the challenges of trading options, is knowing which expiration to go to and which strike price to go to, on top of knowing which underlying you want to actually get options for. So in this case, this is strike price, and something that's very important here is that the current price, which is in this case $370, it's a clear border or boundary here between the different strike prices here. So you can see that the prices, the strike prices that are above are in black with a black background, and the ones that are below are in a different color, which is a kind of like a bluish purplish, or sometimes it's gray. So just so you know, this is gonna come into play later, but so far you can see that there's a difference between the current price and the strike price. So that area is very important. Also, we have the actual option prices, which are also given by a bid and an ask. So in this case, for example, the 380 strike price for 42 days away is trading for $23.25 if you want to sell it, and $25 if you want to buy it. So it's pretty much trading for $25. Let's say you want to buy it, you can pay $25 for a single share of for an option covering a single share of Netflix. Now, on this point, I want to be clear. It's something we're going to that we're going to talk about later. But every option contract, instead of covering one single share, they're normally, actually, I would say 95, 97, 99%, most of them cover 100 shares of the underlying. In this case, a single option contract covers 100 shares of Netflix. So if you want to buy the $380 strike option the call option, you'd have to pay $25 per share. So it would be a single contract for $2,500. But it's going to be covering 100 shares of Netflix. Now, let's do the exercise. Let's say you buy the $380 strike price for $25 per share. So in this case, it would be $2,500. So you come up with $2,500. You buy the 380, the 42 days to expiration 380. What will happen if, let's say, Netflix goes to 450 to 450? It's trading right now at 370. So you have the 380 strike to 450 would be $70. So you would be making $70 per share. Or it would be trading at least $70 per share. So the 2,500 that you put down are going to be trading at around, if there's some time left, maybe they're going to be trading for $8,000. So 8,000 minus 2,500, you'd be making just about $5,500, so $5,500. So right now, one of the things you can notice is that the price only going up by $70, which is just about 20%, would give you just about over a 200% return. This is the power of options. This is the power of call options in this case. If we're talking about the upside, is one of the most important reasons why we trade options is because of leverage. Instead of putting down $37,000, which you might not have in your account, you can put down $2,500 and control 100 shares and benefit and profit from an increase in price that you wouldn't have had access to otherwise. So this is the power of options, and this is the reason why it's very important to me, and it's a privilege for me to be able to introduce you to the world of options. And I hope that you guys stick with us, that you stick with me, and that together we can learn how to use options, how to best put them together in strategies, and learn more and more so that you can use them and take advantage of them in your own trading account and in your own financial strategy, so that your financial plan includes options, which is always a good thing. Thank you very much for being with us. I hope you learn, even if it's a little bit. And hit that subscribe button, and make sure you stay tuned to our channel. We're gonna be releasing new material soon, and this is Call Options. I hope that it was useful for you. Thank you very much. Goodbye.